Markets aren't doing what you've been told. Here's the contradiction. All year, the loudest voices warned of bubbles, crashes, and collapse, yet the actual numbers moved in the opposite direction. And if you're invested or thinking about investing, this gap between fear and reality doesn't just affect portfolios. It affects decisions you make under pressure. The facts are straightforward. In 2025, the S&P 500 rose 17.9%. The Nasdaq 100 gained 21%. Not just tech. Industrials were up 19.3%. Utilities 16%. Financials 15%. Healthcare 14.6%. Not a single S&P sector finished the year in the red. That's not a niche rally. That's broad participation. But here's where the tension starts. At the same time those gains were happening, the dominant narrative was that markets were dangerously concentrated, overvalued, and riding a speculative AI bubble. You heard it everywhere. And most people never checked whether the data actually matched the fear. What the facts show is performance. What they suggest is something far more uncomfortable for market myths. Because if the warnings were wrong about this, what else were they wrong about? And that's where this story really begins. The core issue isn't whether stocks went up, it's why so many people believe they shouldn't have. This wasn't a single lucky quarter or a narrow technical bounce. The gains spread well beyond communication services and technology, which were up 33.6% and 24%. Industrials, utilities, financials, healthcare all moved higher. Even the laggards, real estate at 3.1%, staples at 3.9%, discretionary at 6%, still finished positive. That detail matters because bubbles don't usually look like this. They usually hide in one corner. But here's the framing most people missed. Only 153 stocks in the S&P 500 beat the index's 17.9% average. About 350 came in below it. That's narrower participation than ideal, but it's not collapse territory either. It's uneven, not unstable. Now zoom out, because the bigger shift didn't even happen inside the US. After 15 years of American equity dominance, international stocks surged 33% in 2025. That move coincided with a US dollar that weakened by almost 10%. Global trading partners began repatriating capital, driven by dissatisfaction with US trade and security policies. That's not speculation, that's capital moving. So here's the reframing question most coverage never asked. If money is rotating globally, sectors are broadening, and earnings are holding up, why does the everything bubble narrative stay so powerful? Because fear spreads faster than data. And in this case, the data is quietly telling a very different story. But the real surprise isn't international stocks. It's something closer to home. And once you see it, it changes how the entire concentration argument falls apart. Here's the claim that dominated market commentary all year. The rally was fake. It was driven by a handful of mega-cap tech stocks, and when they cracked, everything would follow. Now look at the actual result. Only 2 of the so-called Magnificent 7 outperformed the S&P 500. 2, not 5, not all 7, just 2. That single data point rewrites the concentration story. Because if 5 of the 7 most talked about companies underperformed the index, the rest of the market had to be doing more work than anyone admits. Price appreciation didn't collapse when those names slowed. It spread. This is where the story flips. The same voices warning that concentration would destroy returns were wrong in the very place they said risk was highest. If dominance is fading, it doesn't mean markets are weaker. It means 493 other companies are finally catching up in price and eventually in earnings. Notice what wasn't said. There was no panic selling, no sector implosion, no cascading failure, just a quieter redistribution of performance that doesn't generate headlines. That's uncomfortable for anyone whose thesis depends on catastrophe. And it sets up the next question. If concentration wasn't the problem, maybe valuation was. That's where the bubble alarms get even shakier. For years, the word bubble has been used like a reflex. Say it often enough, and people stop asking for proof. So look at the valuation data. Not opinions, multiples, price to earnings. Unlike the late 1990s, when valuations exploded higher year after year, PE ratios over the past 5 years have stayed mostly flat. No dramatic expansion, no runaway pricing disconnected from reality. Even inside the most scrutinized area of the market, AI-linked companies, the story doesn't match the fear. Forward PE ratios for companies like Meta, Google, Amazon, and Microsoft have either remained stable or declined. That matters because bubbles aren't quiet, they don't creep sideways. They stretch until they snap. Here's the normalization that should feel strange. We've gotten used to calling anything expensive a bubble, even when the structure underneath is completely different. During the dot-com era, valuations surged while earnings lagged or didn't exist. Today, prices have moved while earnings actually showed up. But here's the part nobody says out loud. If valuations aren't exploding, then panic narratives need a different fuel source. And that fuel usually comes from leverage. That's where the next data point lands hard. Because when you look at debt, the comparison to past bubbles breaks down almost completely. Bubbles don't inflate on optimism alone, they inflate on borrowed money. So look at the debt numbers. During the late 1990s, debt growth went vertical. In just the final years of that cycle, leverage jumped by 111%, then 187%. That's acceleration. That's fragility being disguised as confidence. Now compare that to the current cycle. Debt was essentially flat for 5 years. In 2025, it increased by about 9%, not 90. 9? This is where the contradiction becomes impossible to ignore. We're told this market is dangerously levered, yet the behavior that actually defines leverage-driven bubbles isn't present. No explosion of borrowing, no desperate reach for margin to sustain prices. And here's the line that permanently changes how you see the narrative. You cannot have a classic bubble without classic bubble behavior. And the behavior simply isn't there. Words say mania, data says discipline. Notice what this also exposes. If leverage isn't driving prices, then something else is. And that something else brings us to the most boring, most ignored, and most powerful force in markets: earnings. And once earnings enter the picture, the entire fear structure starts to wobble. Here's where the pressure starts to stack. Earnings have been growing at a robust pace over the past few years. Not projected, not promised, growing. And if you could only look at one data point to understand how markets behave, this would be it. Earnings are the gravity of stocks. Now layer in what's happening inside the most controversial theme of this cycle: AI. During the dot-com era, speculation ran far ahead of results. Today, the opposite is happening. AI investment is being absorbed into real businesses, producing measurable outcomes. Take one concrete example. Despite repeated predictions that AI would destroy its core business, Google integrated AI into search. The result wasn't collapse. Its stock rose 65% in 2025. That's not a story about hype outrunning reality. That's execution catching up to expectation. Stack the developments: earnings rising, valuations flat, debt contained, market leadership broadening, global capital rotating. None of these individually disprove a bubble narrative. Together they create something else entirely. A market that's harder to scare, slower to break, and more resistant to simple explanations. Now watch how fast this escalates. Because when markets don't behave the way fear predicts, people don't just get cautious, they get confused. And confusion is where bad decisions multiply. So here's the question that hangs over everything. If this continues, if earnings keep doing the work, fear says prices shouldn't, what happens next? What happens if this continues? This is where it stops being abstract and starts hitting real life. Because when people are convinced a collapse is imminent, they don't just change charts. They change behavior. They delay investing. They pull back retirement contributions. They sit in cash waiting for a crash that never arrives, and over time, that gap compounds. If you're a regular investor, this matters more than market timing ever will. Missing a handful of strong years does more damage than riding through volatility. And that's exactly what constant bubble warnings encourage. Not prudence, paralysis. Look at the environment described here. Broad gains, earnings growth, contained debt, yet the emotional experience for many people was anxiety. That disconnect doesn't come from markets, it comes from information intake. Notice how subtle the cost is. It doesn't show up as a headline loss. It shows up years later when portfolios are smaller than they should be, simply because fear crowded out patience. This isn't about ideology, it's about incentives. Loud, catastrophic predictions travel faster than measured, data-driven analysis, and the audience absorbs the stress without getting the payoff. If this feels familiar, say so in the comments, because once you see how this pressure operates on individuals, the next layer becomes unavoidable. This isn't just a media problem, it's a systemic one. Here's the unsettling insight most coverage never touches. Markets don't just move on fundamentals, they move on attention. And attention is rewarded for intensity, not accuracy. Calm, data-driven perspectives don't spread as fast as fear, because fear creates urgency. Urgency creates clicks. That incentive structure quietly shapes what people hear. If someone has been calling for a crash for years, they can keep calling for it indefinitely. There's no expiration date on fear. When it doesn't happen, the timeline just resets. Meanwhile, the actual mechanisms that matter keep operating. Earnings compound, companies adapt, capital reallocates globally. None of that feels dramatic in real time, so it rarely dominates the conversation. This is how myths persist, not because they're supported by evidence, but because they're never fully falsified in the public mind. A bubble that doesn't burst is reframed as one that's about to. Here's why that detail changes everything. When fear becomes a permanent background noise, it stops being a warning and becomes a distraction. And distractions are expensive. The system doesn't need you to be wrong about the market. It only needs you to be unsure long enough to hesitate. And now the story reaches its edge, because uncertainty doesn't stay static. It eventually forces a choice. From here, there are two paths, and neither is clean. In one path, the data keeps doing what it's been doing. Earnings continue to grow. Valuations stay contained. Leadership keeps rotating instead of collapsing. International markets keep absorbing capital as the dollar stays weaker. In that scenario, the biggest risk isn't a crash, it's disbelief. People stay underexposed, waiting for a signal that never arrives, while compounding quietly does its work without them. In the other path, something breaks the pattern. Earnings slow, policy shifts hard, global capital reverses. That doesn't require a bubble. It only requires a change in momentum. And if that happens, the same voices warning today will say they were early, not wrong. Notice the asymmetry. One path rewards patience and discipline. The other punishes excess. But both punish panic, because panic doesn't adapt. It reacts late. This is why the next move matters more than the last one. Markets are not frozen, they're forming expectations in real time. And right now, those expectations are being pulled between fear that's loud and data that's stubborn. The next signal hasn't fully arrived yet, but the pressure is already building. And that brings us to the final question this story leaves hanging. What are you actually responding to when you make decisions? The numbers or the noise? Here's the insight that ties everything together. This wasn't a story about a raging bubble or a flawless market. It was a story about mismatch between what people were told to fear and what the data actually showed. broad gains instead of narrow fragility, flat valuations instead of excess, contained debt instead of leverage, earnings doing the heavy lifting while noise stole the spotlight. Reframe it this way: the real risk in this cycle wasn't optimism, it was distortion. When perception drifts too far from evidence, decision-making breaks down long before markets do. And that's the loop most people never close. Markets don't need to collapse to cause damage. They only need to confuse enough people into stepping aside at the wrong time. This story isn't finished. The next chapter depends on whether earnings keep leading, whether global capital keeps rotating, and whether fear keeps outperforming facts in the attention economy. If you want to stay ahead of that curve, not louder but clearer, follow and subscribe for the next layer of this analysis. Because the most expensive mistakes usually happen quietly, long before anyone calls them obvious.